All right, hello everyone and welcome to cpaacademy.org. My name is Christine and I'm going to be your moderator for today's 1-hour webinar on dynamic and creative charitable planning, charitable lead annuity trust planning. All right, before we get started, I want to make sure everyone can hear and see everything okay. So let's do a quick check by heading over to your questions box on your GoToWebinar side panel and just type me a quick message to let me know that you hear my voice. You see our lovely presenters on their webcam right now. You should see 4 of our presenters. And you see the title slide of the presentation. And while you're there, let me know where you're tuning in from. Hello from sunny Charlotte. Thank you so much for letting me know. Avi is good in Iowa. Fantastic. It's good to see all the presenters. All right, Fernley, Nevada, Ohio, Georgia, Toronto, Idaho, California. All right, looks like so far everybody is good to go on audio and visuals. But if you do experience any technical trouble today or you have any questions, you can let me know in that questions panel and I'll come by and help you troubleshoot. This is really where you're going to put all of your questions and comments and feedback that may come up for our presenters during the webinar. All right, let's go over some housekeeping for credits. Today's session is going to qualify for 1 CPE credit. In order to earn the full credit, you must stay logged in for 50 minutes of our allotted time and answer the poll questions. We are going to launch 4 polls total throughout the presentation, and each time a poll is launched, a poll box will take place of where you currently see the presentation slide, and you will be able to select your answer and submit your vote. To earn full credit, you'll need to answer at least 3 out of the 4 polls. And once the webinar is over, we're going to make sure to process your CPE credit, and that will be in your CPA Academy accounts within 24 hours. And for handouts today, you will be able to find those on your GoToWebinar side panel as well under the handouts box. So you can easily download and follow along or refer back to them in the future. If you do have any issues downloading the PDF, please let me know and I can send it to you directly. But also copies of the handouts are also available in your CPA Academy accounts. All right, that's it from me for now. Let me step out of the way and welcome today's presenters, Alan Gassman, Brandon Ketrin, my apologies, Michael Lehman, and Jerry Hesh. Welcome, gentlemen. The floor is all yours.
Well, thank you very much. We appreciate the warm welcome we always get at the CPA Academy. For those of you who have not seen this before, this is the 3rd installment of a 4-hour course on charitable planning. And we've been working with Jerry and Brandon and Michael to get a nice program together so that people can have a firm grounding in this area, realizing that in 4 hours, it's almost like a microsecond. There's so much to cover, but at least we can give you the basics and also some good planning ideas. Part 1 and Part 2, if you'd like to see them, are archived by the CPA Academy, all free of charge. So we hope you'll go in and enjoy them. And as always, give us your questions, comments, and suggestions. We're going to save at least 10 minutes at the end of this presentation to answer your questions. So send us some very, very difficult ones. We will appreciate it. So I'm going to give a little 8 or 9 minute start off here. Everything I say is going to be repeated at least once during the presentation. But what is a charitable lead annuity trust, and how would I explain it to my clients? So I show here a lifetime charitable lead annuity trust. The client is alive, they're doing well, they would like to help some charities, and they wouldn't mind passing some assets to their children in a way that they could avoid estate and gift tax. So they put a certain amount of assets into a charitable lead annuity trust, which pays a certain dollar amount to charities for a certain term. And at the end of the day, when the charities have received all their payments, what is left in the charitable lead annuity trust can go to be held for the children. And due to a wonderful anomaly in the law and how calculations work, you can set this up so that it is considered to be 100% charitable. Put your assets into it, and what's left after the charity has received all of its payments may be a considerable amount passing to the family estate tax free and gift tax free. And there may also be a charitable income tax deduction upon funding. So I'm going to take you to another slide. and show you what the asset that many planners recommend is put into the charitable lead annuity trust, and that is a non-voting member interest or a limited partnership interest in an entity that itself owns other assets. So this allows valuation discounts to be used in a reasonable manner and allows more in value to pass to the trusts for these children or other individual beneficiaries after the CLAT term. Now, that again, taking you back, a lifetime charitable lead annuity trust would look like this. A little bit more information on the right. The charity that the trust benefits can be changed. So they may want to start off with their favorite charity, and then they're not getting along with their favorite charity so well. The trustee of the trust can change the charity. Another feature you have to be aware of is the remainder interest going for the family will not be generation skipping tax exempt. The family must expect that what the children receive will be taxed in the children's estate unless they choose to leave it to charity, or they have estates that are lower than the exemption amount. Now, more information on this so that it's boiled into one chart for you. This is the one you should laminate, take it in the hot tub, wherever you go. This is a really good slide. It's the same slide, but what have I told you on the left here? It's a lifetime charitable lead annuity trust. There are two ways for this to be taxed. If you want a charitable deduction on funding, then you need to make it what we call a grantor CLAT. It is disregarded for income tax purposes as long as the charity is getting payment. So the client gets a charitable deduction on the value of the assets that go into the CLAT, but the client has to pay income tax on the income of the CLAT with no deduction for what goes to charity during the CLAT term. And this is why you will see that many, many times the CLAT will be funded with growth stocks, low dividend paying stocks, and bonds or municipal bonds, so that the grantor does not get socked with a lot of income during the trust term. And if the grantor dies before the charity gets the remainder interest, then the grantor will have to recapture some of the charitable deduction.
Alan,
yes.
okay. Let's suppose you have a 20-year charitable lead trust. You take a income tax deduction equal to the present value of the annuity payments for the next 20 years. The individual dies in year 18. So 3 years of charitable deductions that you took while you were alive will not be made until after your death. So you have to report on your final income tax return the present value of the last 3 charitable deductions. It is not lost.
Oh.
When the grantor dies, the trust becomes a regular trust, and the lost charitable deduction under the recapture rules shifts to the now complex trust, and then the complex trust for the last 3 years reports its income and takes the charitable deduction. So the charitable deduction isn't lost, it's merely shifted to the trust in existence after death.
Very good. Now, the other type of CLAT is a non-grantor CLAT. You would get no income tax deduction upon funding, but you would pay no income on the CLAT income. The grantor is not responsible for the CLAT's income. The CLAT is what we call a complex trust. It has income, but it gets a tax deduction for what it pays to the charity. So basically, there is no income tax in the arrangement. It provides the estate and gift tax savings, but it does not provide income tax savings. So most of the CLATs we see that are lifetime CLATs are the grantor CLAT. Now, what can you put underneath a CLAT? It is somewhat limited, and Michael's going to talk about that in a little while. Well suited for stocks and bonds. You may be able to put promissory notes in there. C corporation stock may work if it's non-voting. Not suitable for IRAs. IRAs don't do well with CLATs. Can't hold S corporation interests. Other limitations apply.
Alan, let me give you a simple example. You have a non-grantor CLAT that has taxable income of $1,000 and the annual annuity is $850. So the non-grantor CLAT reports $1,000 in gross income, takes an $850 charitable income tax deduction, and is a separate income tax taxpayer. Its taxable income is $150.
Right.
Alternatively, the 850 is the annuity, and the trust for that year has $800 of taxable income. So what happens to the, so basically you can't have negative income. So there's like a tax loss. What happens to that $50 tax loss if it's $800 of gross income and an $850 annuity that's paid?
I don't know. What happens?
I don't remember either.
I remember either. I'm making note of that. Get an answer to that by next week.
But conceptually, I think, and we'll discuss this next time, but I just thought of that, and I want to verify the answer, and we'll give you the answer next time.
Beautiful. Okay, the other type of CLAT is a testamentary CLAT. So when the client dies, there's no income tax deduction, but there's also no estate tax if the client would prefer to leave assets to a CLAT that will qualify for the estate tax charitable deduction as if it was 100% going to charity, even though at the end of the CLAT term, which would typically be anywhere from 12 to 20 years, there may be considerable assets going to the children. And the Jacqueline Onassis Kennedy arrangement was, I leave these assets to my child. If it is disclaimed, then it can go to a CLAT. So then the children had the ability to have a trustee decide whether they would pay estate tax on it or let it go to the CLAT and wait a longer period of time. So that is the testamentary CLAT, and the testamentary CLAT can be funded with non-voting interests in a family entity so that more value in the long run would go to the children, less to charity, even though you're getting a 100% deduction. So I have these slides here. You can use them with your clients, and I'm going to cover the first polling question now.
Alan, let me point out, a lot of people set up the charitable lead trust in their will at death and these are individuals who's probably already done significant estate planning that have assets outside of their estate. And they basically say, I got plenty of assets that I left to my children in prior estate planning, and I don't want to pay any estate taxes. So that kind of individual is a good candidate for a testamentary charitable lead trust, because what they do is they basically say, whatever amount would be subject to estate tax, I'm going to put into a zeroed out charitable lead trust. But here's the key. You don't know what amount is there. So what you have to do, and this is where you can get complex, there in the forms, there are formulas that you can use to maximize the charitable deduction, because a lot of times people will have remaining exemption, so they don't want to leave everything. They only want to leave to the charitable lead trust the amount of their gross estate in excess of their exemption. So there's a formula, and that is there, and there's articles on it, so you can reference those. Okay.
Very good. So let's do our first polling question. And by the way, on all of our polling questions, the answer is all of the above. So a CLAT can be A, fully tax deductible as if totally charitable, B, lifetime CLAT or testamentary. Testamentary means it happens on death. C, it may be funded by part ownership of an LLC, or D, all of the above.
All right, if you're hearing my voice, we have poll question number 1 up on the screen, so we're going to close this down in a couple seconds. I want to make sure everybody gets a chance to vote. All right, thank you everybody for voting. I'm going to close poll question number 1 down in 3, 2, and 1. And majority voted all of the above. Back to you.
Beautiful. So we are so pleased to have Michael Lehman here with us. He practices the majority of his time is handling tax-exempt organizations and tax-exempt issues. He is our law firm's go-to person for these types of questions and situations. It's a complicated world. You can read the entire B&A portfolio on any of these entities. You'll still have questions for Michael. So Michael, can you tell us what slide 14 is about? What are all these rules that we at least need to know are out there?
Thank you, Alan, for that nice introduction. So CLATs, and we're going to keep this brief because there's a whole lot to get to about how to set them up and plan for them. But they are subject to these rules that private foundations, you probably all know about private foundations. You think about the Ford Foundation, the Rockefeller Foundation. And the CLAT doesn't look anything like this, you might think. But under rules in the tax code for all exempt organizations, and CLATs are thought of this way for that, there are these rules that are supposed to regulate their behavior. For real private foundations, classic private foundations, the idea is they're not responsive to the public. A family or a corporation sets them up and funds them, and they can do their own thing. If you're the American Cancer Society, the March of Dimes, or something like that, you need the public's money, and you'll be responsive to the public. But if you're set up by me for my own charitable purposes, I don't care. So these rules, 49, 41, 2, 3, 4, and 5, are basically all behavior regulation. In traditional foundations, they have a lot of impact. Every day I deal with some of these issues for operating foundations. CLATs, they're technically applicable. They tend not to be of terribly much concern. I'll just briefly state what each one of them is. The last one on the list, Jerry had mentioned earlier in the partnership example, unrelated business taxable income. That's a different thing. All exempt organizations, even public charities, pay that if they earn income from things that aren't related to their purpose. CLATs, they don't have purposes in the same way that traditional charities do, but they can still earn income that falls within these rules. They could mostly get that through either having debt-financed assets. That's a big way that unrelated business income is generated, although there are some nice carve-outs for debt-financed assets, mortgaged assets, that come by gift or bequest. You get grace periods to hold and dispose of them, which is in the CLAT area very helpful. The other way exempt organizations like a CLAT could get unrelated business income is if they own a pass-through entity, partnership or an LLC that's doing a business, and the nature of that income flows through. So there is the CLAT would pay tax at corporate rates on that. I don't tend to see a lot of CLATs actually get UBTI, but that can happen. The other rules, as I said, they're behavior monitoring rules. Self-dealing rules limit transactions between certain people, 49, 46, your disqualified person, and the exempt. So here, it's basically the grantor and the grantor's family. We don't have 49, 42, which forces regular foundations to give away money. CLATs are already making their annuity payments, so they're covered. 49, 43, 44, and 45. 49, 43 limits percentage interest in business enterprises that can be held. And of course, CLATs tend to get funded with business interest. But there are special ways in which these rules can be managed in the CLAT environment. But that is out there. jeopardy investments are kind of a curious thing. It's directed at high risks or very unusual alternative investments or heavily concentrated investments. Where I deal with it most in family planning is giant blocks of equity interests in family businesses, which concentrate risk in them. And again, there are ways to manage that. Taxable expenditures rarely come up because what CLATs do is they give their annuity payments, which are perfectly legitimate charitable expenditures, they give them to charities. Other organizations, if they spend money on things like lobbying or political activity or gifts or distributions to individuals, they can fall in these rules. The effect of all these rules is penalty taxes on the entity. They can also be penalty taxes on the decision makers. And they can all be very, very high level. So again, operationally, I tend not to see them kick in very often, but in planning the sort of assets that are going to go into a CLAT and the sort of things that will be done with them, these do have to be borne in mind.
I have a question, Michael. Can the unrelated business taxable income, if we treat the CLAT as a grantor trust, so for income tax purposes, the individual grantor is deemed to own all the trust assets, is that subject to UBIT?
Right, good point. In the grantor CLAT, it's essentially meaningless because the grantor CLAT is not a separate taxable entity. It's all treated as the tax attributes of the grantor. So UBTI in grantor CLAT, that's basically a non-issue. It's the non-grantor CLAT that really is.
But it's subject, the grantor CLAT is still subject to all the things through 1 through 6.
Yes.
So, because I saw someone set up a grantor CLAT and say you don't have any problems, forgetting about all the others.
I would not say that, but they don't have to deal with UBTI.
All right.
Michael, generally, can you put non-voting LLC interests in a CLAT without causing a problem with excess business holdings?
That's a very important observation, and I think we've got structure a few slides down that illustrates non-voting. The excess business holding rules, 4943, they're directed at ownership of voting interests in business enterprises, and very often I implement structures where, whether it's a foundation or a CLAT or some other tax favored vehicle, we put non-voting interests into that, and not worry about 4943. It's got to be respected and it's got to be done, but it's not sort of a sham, but done properly. And the IRS, in a wide variety of settings, has approved non-voting LLC or similar interests to get out of this particular concern.
Okay, so I'm going to show one more slide and then I'm going to get out of the way and let Jerry lead the discussion. But this is an interesting one that a client is, looking at very seriously. You've got a revocable trust, which provides when I die, put the amount that passes estate tax-free into GST trust for my children and leave the rest to the CLAT. So I don't want to pay any estate tax. I want to take care of the family charity and take care of my children. Well, the assets are 12 million in stocks and bonds and 20 million in S Corp stock. And after he dies, he can't have S Corp stock in a CLAT. It's not a permissible S Corp shareholder. So what can he do? There's what I call an administrative note exception to the self-dealing rules. So what he could do is put 11.5 million of stocks and bonds and 200,000 worth of LLC interests into the GST trust. What they did in this private letter ruling that I'm going to show you in 2014 was the first step. They gave the GST trust almost all the assets and got a note back for the excess value. The note went into an LLC, and then they distributed the LLC 1% voting to the GST trust. So the GST trust ended up with 11.7 million in total value, 99% non-voting to the CLAT, and then a little bit of money was left in the trust to administer the estate. And if there was anything left after that, it went into the CLAT. So this was explicitly permitted and is a very good way to help assure your clients that if they leave the remainder interest to a CLAT, the children, within reason, will be able to determine what's going to go into the GST trust, and the GST trust can get more than its share of assets in exchange for a note. Now, in this 2014 ruling, the note, Jerry, was at the applicable federal rate. And the IRS in the ruling said that they accepted the fact that a 99% non-voting interest in an LLC holding a long-term applicable federal rate note received a fair amount. And I personally would not feel comfortable with this. I think whoever got that ruling maybe got more than what they deserved. I would have put that note at market rates, and I would have given the CLAT a liquidation right over the LLC. Maybe they did that. It's not really apparent. But I just thought it was a neat example of what you can do with CLAT planning. Michael, any comments on that, or Jerry, any comments?
Well, conceptually,
I've done a couple of those, and I think it's been a pretty neat solution.
is you had an asset that you didn't want to go into the CLAT, so you converted that asset and you sold the asset to somebody and have a promissory note, which is a passive asset. And basically, what you're really doing is contributing the promissory note to the CLAT through the LLC.
Right.
So we've converted a bad asset into a good asset.
Right.
Yeah.
Then I have the excerpts from the private letter ruling for you. So let's go to the second polling question. A CLAT contribution that qualifies for an income tax deduction, A, must be a grantor CLAT. B, the grantor CLAT does not need to file a Form 1041 because it's disregarded for income tax purposes. And C, always the answer, all of the above. Jerry, I probably wouldn't be a good professor if I give the students all the answers, right?
No. That's it.
All right, this is poll question 2 out of 4. We're going to have 2 more questions after this for the remaining hour. But for this poll, I'm going to close it down in 3, 2, and 1. And everybody voted both of the above. Back to you.
Okay, Jerry, I'm on to your slides now. You can lead us through this last half hour.
Okay. Trying to describe all this stuff in overall terms can be difficult. And part of what our objective is how to communicate very complicated stuff in an understandable manner. And the easiest way to do that is with simple to follow numerical examples where you don't have to use technical terms and they can just follow the numbers. So that's what we did in this situation. So senior contributes a corporate bond, $1 million corporate bond that pays $35,440 of interest annually, and the bond matures in 30 years. So he puts it into a CLAT for a fixed term of 30 years, and coincidentally, the annual annuity that must be paid is the same interest income that the CLAT receives. So essentially what this means is at the end of the CLAT term, the children who are the remainder beneficiaries of this CLAT at the end of 30 years is going to receive $1 million because the bond gets redeemed and the CLAT has $1 million of cash and it gives the $1 million to the children. Now, what's interesting is the children are getting $1 million at the end of this CLAT term. Doesn't that seem to be a taxable gift? And the children should have a gift equal to the present value of the right to receive $1 million some 30 years in the future? But Brandon, how do we value that right to $35,440 a year for 30 years?
Yeah, well, the good news is it's actually actuarially calculated. So you use the discount rate that's published under the 75/20 rate. So in your case here, it's 0.4%. So the present value of that $35,444 annually for 30 years is $1 million. So in the IRS's eyes, what you've done is you have $1 million asset. You're projected to give $1 million to charity. It's not considered to be a gift to that future generation, even though there's going to be $1 million left at the end of the term. So it's a really nice benefit here and works out really well.
Because the amount of the gift is the value of the asset going into the trust less the present value of the annuity payable to the charity. So 1 million going in less the present value of the annuity of 1 million means the taxable gift is 0. And we call that a zeroed out CLAT. So that is the concept, because the 4% discount rate is essentially assuming that the $1 million is only earning 0.4%. So essentially, if it's only earning 0.4% of 1% of $1 million, or $4,000, the difference between 35 and 4,000 is deemed to be amortizing principal, and all principal would get fully amortized at the end of 30 years. So that's how the zeroed out CLAT works. Very, very simple. Now, the next question is, in traditional estate planning, we never put our assets directly. We never sell our assets directly to a GRAT or an installment sale or gift the assets. We basically put the asset into a family entity, take back a non-voting interest, whether it's an LLC membership interest or a limited partnership interest. And suppose I put the $1 million bond into a family limited liability company, take back a 99% non-voting interest. I take a conservative valuation discount, and essentially I contribute the discounted LLC or family limited partnership interest worth $750. So if I contribute $750, then all I have to do is have an annual annuity equal to that will discount it out. So in the example, all I have to do to zero it out is what is the present value of 35,440 for 22 years is 750. So I don't have to use the 30-year CLAT. I can limit it to 22 years, and therefore that discount kind of also passes free. So when the partnership is, I'm saying when the CLAT ends, you still have another 8 years to go, and that's what the children get. So that's conceptually is why we first discount the asset. And this is done all the time with grants and installment sales. So it's not something that is risky. The only thing that's risky is taking a very aggressive discount. And I always recommend that don't be overly aggressive on your discount. Take a discount equal to what the IRS offers in settlements of the valuation of these limited partnership interests. So that conceptually is how the CLATs, the zeroed out CLAT works. And now to show you all sorts of different variations of this, I turn it over to Alan.
Okay, so we ran some numbers for a client back in October of 2019, and he wanted to make a $10 million contribution of assets he predicted a 6% growth rate. And if we were to do a 12-year equal annual payment GRAT, then at the end of the day, after all the spreadsheets are run, the charity ends up having received $11,209,000, not taking into account growth in what the charity got. But if the charity invested that money at 6%, it would have gotten $15,758,000. The children get $4,363,000, estate tax free, gift tax free. So basically 28% goes to the children, 72% to charity. On the other hand, if we did not an equal payment, but you can go with a you can go with an annual increasing payment. The payments start low, they increase by 20% a year. You start with the charity now getting $13,965,000, the children $6,156,000, the kids got 35%. If you ramp that up to a 20-year CLAT with 20% increasing, you get the children at 57%, the charity at 43%. But what if we, instead of making a distribution of $10 million worth of assets, what if we put $15 million worth of assets into an LLC and gifted a 99% interest, assuming a 33% discount, which is a bigger discount than Jerry likes to take. Jerry likes to take about 25%. This client was pretty aggressive. The end result here with a 12-year GRAT, the children got 59%, the charity 41%. That's a lot better than the children 60%, Uncle Sam 40%, considering that the children run the charity, isn't it? And a 20-year situation, 73% to the children, 27% to the charity. That doesn't include the fact that the children can receive trustee fees for operating the GRAT. So that is some pretty strong stuff when you stack it all together. Any comments on that?
Now, the key is you can communicate this. The client wants to know, what if I do this? What if I do that? And what you have to do, and given that the accounting profession is much better than the estate planning lawyers who do this, the accountants can really offer a service to the estate planning lawyers to say, we'll do all the calculations for you. So hire us to do all the what if scenarios. But the nice thing is showing them all the different variations, then they can decide which of the situations they want to adopt.
So Jerry, how much better will this be now with a 0.4 75/20 rate versus a 1.86? So this will be quite a bit better, I guess.
Yeah, because remember, the 75/20 rate assumes that the rate of return will be 1.86%. And that means, but when we have 0.4%, and by the way, the current rate for January is 0.6%, but you're permitted to use the discount rate for the current month or the preceding 2 months. And in December, it was 0.6%, and in November, it was 0.4%. So for the rest of January, you can use 0.4%.
Very good. Jerry, do you want to say anything about your slide 37 on the testamentary zeroed out CLAT?
No, you can do it. I'm having trouble reading it.
Brandon, you want to take us through this?
Yeah, so the idea here is basically that you have a similar example to earlier where you have an estate that's valued more than $12 million. So you're going to have an estate tax on death. Well, one potential option is you can use the full exclusion that they have, the currently $11,580,000, to put into a trust that would be, GST exempt and not subject to estate tax. And then the excess can be put into a testamentary zeroed out CLAT. So if you, let's say you have 20 million of assets, you put 11 million into the credit shelter trust, the excess $9 million could go into a testamentary zeroed out CLAT where it would pay an annual annuity to charity. You could structure that so it could be the 20% increasing payment to the charity each year. So that way you can maximize the benefit back to the family. But in this situation, the gift to the CLAT is going to be treated as fully eligible for the estate tax charitable deduction. So you would eliminate the estate tax, and then what's left at the end of the CLAT term can pass estate and gift tax free to the children. So it's a nice way to eliminate estate tax and then leave a little extra kicker for the family at the end of the CLAT term, and also benefit a charity in a nice way.
But Brandon, the kids say, wait a minute, that means I can't get the excess until 20 years from now. Why should I have to wait 20 years?
Well, that's just the case. We can do it to where the annual charity is actually a family foundation that the children can run and manage and have charitable goals and adventures and get them introduced to the charitable world and how they can benefit others. So that's one way they can get a little bit of access to the money. But the other option is that it's subject to estate tax and you only get 60% of it. So
by the way, the 12 million that was under the exemption, the kids get immediate access to that.
Right.
So basically what you're saying is you get immediate access to whatever passes by the exemption. You don't need everything. So let's do the charitable and postpone what's the rest of what you're going to get to later.
So Michael, have you, I assume that you have conversations with clients about what they can do with their family foundation, what they can't do. Are they generally happy with the family foundation? We found that most clients are, but we don't have as much experience in this as you do.
I do find they tend to be very happy with the foundations. Ears always perk up when I mention that there's a self-dealing exception to paying reasonable compensation. That reasonable is in light of all the facts and circumstances. You don't get that at a $50,000 foundation, but in the millions, those foundations, they can pay. And I've set these structures up where the charity is the family foundation. I discourage foundations if people don't actually want to be actively involved in them. If somebody just likes to see that checks get cut to certain causes, staff, donor advised funds will often be good enough for that. But where a family has actually legacy interests, want to get the next generations involved in giving, and they want to be kind of active and thoughtful and maybe just do more than cut checks, I find the foundations are very appealing, and I've had rarely shut one down over the last 30 years.
That's great news. Okay, let's do a polling question here. A zeroed out CLAT is A, considered to be 100% charitable under the IRS calculation rules. B, can save significant estate and gift tax. And the correct answer, C, both of the above.
All right, thank you everybody for voting on poll question 3. We're going to close this question down in 3, 2, and 1. Looks like everybody voted for the right answer here, both of the above. Back to you.
Beautiful. Okay, I'm going to skip now because we only have a few minutes left, maybe 5 minutes left. Jerry, I want to ask you, if I'm in poor health and I want to do a CLAT, and if I die early, the charity no longer gets any payments. It all goes to my children. Is that a good, viable planning alternative? It's like a self-canceling installment note. Is that a good trick to play?
So what you're saying is you set up an inter vivos CLAT while your life. The charity is going to get the annuity for the rest of your life. And the individual who sets it up, or the measuring life, is someone who is not expected to live that long a period of time. Because remember, the charitable portion is determined based on your mortality tables. So an individual age 70 under the mortality tables has a life expectancy of 14.2 years. So if you set up a charitable lead trust for life, the present value of the right to the annuity amount for 14 years is the amount of your charitable deduction. If the individual dies 6 or 7 years into it, the charity gets far less, and the more goes to children at the end of the CLAT term. So that's not a problem. But what happens if I happen to have an aunt who is suffering from terminal cancer, and I'm very ghoulish, so I want to set up what I call a ghoul charitable lead trust and have the measuring life be my aunt, who I don't expect to make it beyond a year. Or suppose the individual is, in extremely poor health, and the doctor says he ain't going to make it more than a year or two. What do you think the IRS would do with something like that?
Well, I think you used to be able to do that, but now you can only use your life or your spouse's life. Is that what the rules are under the GOUL regulations?
Well, first of all, people used to go to a nursing home, find somebody elderly, and make a gift of it. Basically, the IRS found that to be an abusive transaction and said you can't go and use an unrelated third party as your measuring life, but you can only use family members. But in addition, under Section 7520, you can disregard the mortality tables if the individual has a significant probability of passing away within 12 months or 18 months. It's called the 50% terminal interest rule. So basically, but if someone is in poor health, we did a lifetime CLAT for an individual who was 60 years old, was about 100 pounds overweight, drank a 6-pack of beer a day, and also smoked unfiltered Chesterfield cigarettes. And we did a CLAT for him. And it turned out he was 60 years old, so his life expectancy was about 22 years. He died 8 years later. And guess what? Under the tables, the IRS has a presumption that says if the measuring life survives more than 18 years, we will use the standard mortality tables. But don't do this for someone who you know is going to pass away within a year or two. But someone who is in less than poor health, it's not a bad bet.
Is it the same? Is it the same rule that applies for a private annuity, or is it more like the rule that the IRS tried to invoke in the Davidson case?
No, because it's an annuity, and 7520 applies to all annuities. So a charitable lead annuity trust the IRS is bound by its own rulemaking regulation, which creates a presumption that if you survive 18 months, we'll use the mortality tables.
And if you have a better than 50% chance of surviving 12 months, you can use those tables.
Yeah, but I prefer that they survive the 18 months.
Right. So Brandon, do you want to lead us through some questions? Or actually, let me do the last polling question here. So those people who are in states that only require 50 minutes can leave. Not that they ever would. Okay, if you want to terminate a CLAT early, the charity has to receive all the future payments that it would have received. So if you're doing a 20-year CLAT and there's at 100,000 a year and there's 5 years left, you would have to give the charity the whole 500,000, no discounts. You have to get court approval. The beneficiaries can receive what is left, and the answer is both of the above. And I'm sorry if these questions are too hard for you guys. I'm trying to make them livable for a late afternoon on the East Coast.
All right, thank you everybody for voting on this last poll question. We're going to close this down in 3, 2, and 1.
Now,
And everybody voted for both of the above. Back to you.
okay, now, we did not get through all of the materials. In the first and second sessions, we also did not get through all the materials. And in this,
Are you muted? Christy, I can't hear him.
Hey, Jerry, I cannot hear your audio. Oh, I don't think he can hear us either.
I can hear you.
Oh,
There
here
we
we
go.
go.
You're back.
There you go.
The thing is, in the first 2 sessions and in the third session, we did not cover all the materials. Our philosophy is to do a few things well rather than too many things superficially. So the fourth session, all the stuff that we did not cover in the first 3 sessions, we will be covering in the fourth session. So you're not going to miss out on it. It means you just have to come back next week. And we have the polling questions.
Yeah.
Not the questions.
Jerry, I got a question for you. If you have an otherwise healthy individual, generally it would probably make more sense to do it for a term of years versus for the life of the individual due to the distortions in the mortality tables.
Exactly, because the mortality tables are 20 years old, and they're based on the U.S. population as a whole, and our clients are much healthier, and the average 70-year-old who would do a CLAT, if you do a CLAT for life, they'll give you 14 years as the value of the annuity, but if he survives 20 years, there's an extra 6 years of annuity payments that you don't get any benefit from. So to eliminate the distortions caused by the mortality tables, a lifetime CLAT for a fixed term is far better. So if you have an individual age 70 who you expect to live to 90, do not do for.
Oops, we lost him again. Testing 1, 2. Can't hear me either.
Yeah, I
can
can
hear
hear
you.
you, Alan.
It might be
Oh.
his internet connection. Looks like it's kind of going in and out. Can you hear us, Jerry?
Yeah, so basically,
There we
if you
are.
have expecting to live to age 90 and the mortality tables say there's a life expectancy of 14 years, don't do for life, do a fixed term of 20 years so you get the full benefit of all the annuity payments the charity will receive.
All right, here's another question. Can you dump a retirement account, an IRA, into the CLAT and avoid or defer the estate tax or income taxes associated with the retirement account?
Michael, you want to take that one? Can you dump an IRA into a CLAT?
Can't hear Michael either. I don't think you can do that. Just to answer the question, I don't think it's a prohibited transaction of the IRA, and it doesn't provide any benefit, unlike you could do it with the
No,
charitable.
you can't do it. I get the impression that you couldn't hear me. No, you cannot do it with an IRA.
There you go.
An IRA, remember, is compensation for services, and you can't assign compensation for services to another unless there's a statutory provision that allows you to do so. So IRAs cannot be put into a CLAT.
Do assets going to a testamentary CLAT receive a step up in basis?
Michael, you want to answer that?
They're included in the gross estate.
Yeah, absolutely.
All right. Are there limits on the types of charities that can be beneficiaries of the CLAT?
Yes
I don't
and
think
no.
so. Well, what's your no?
The thing is, depending on the types of charities, the charitable deduction might not be based on the value, but the basis of the property.
Mhm.
So even though
Good point.
all the charities are eligible, for certain charities, you can't use value. You're only limited to basis.
Well, you're limited to a percentage of adjusted gross income. For example, if you use a public charity or a private operating foundation, you can use 50% of adjusted gross income. Up to 30% of the 50% can be appreciated assets. But if you're using a private foundation that's not a private operating foundation, then I think you have, what, 30% of adjusted gross income and only 20% can be appreciated assets. So that's where the difference would be made. Here's a good question for Michael, I see. What is the Biden administration, the Senate, and the House going to do to all of these laws this year and next year? That's the question everybody's asking.
This year, 2021, I don't know anything's going to happen in 2021. So I'm going to encourage clients to try to do a lot of planning in 2021. Of the longer horizon, I think everybody expects there will be some less generosity, whether it's in limit. I don't think they're going to like remove fundamental planning techniques, but I'm expecting there will be higher rates, less exemption, and things like that.
Yep. Let's see.
My inclination is the Biden administration most likely will not rush something through like the Trump administration did. And Biden has said, I want consensus. So what I think will happen is they'll make proposals. They'll have both. They'll have a lot of testimony and have everybody have an input in it. And I think what will happen is that we'll reach a consensus with both the Democrats and Republicans in both houses. At least that's what we hope will happen.
Yeah, that'd be a welcome change.
That's the way tax laws used to be enacted.
Right.
It used to be.
And
So-
we're going to do some, we're going to, a lot of these other questions in the 2 minutes we have left, why don't we just leave that for next time so we can spend time on it instead of having to rush through it?
Yeah, the only thing I want to ask Jerry and Michael is, I see here on slide 76, there was a private letter ruling where the IRS said that when a grantor CLAT gives an appreciated asset to charity, the grantor should pay income tax as if that asset was sold under the Keenan case. Is anybody doing that, or is everyone ignoring that private letter ruling? Or what does the profession think about that?
Well, when you set up a CLAT, the trustee has an obligation to pay a fixed dollar amount. And under general income tax principles, if you use an appreciated asset to satisfy an obligation, that's an income tax realization event. So if I have an asset that is worth $10,000 with a basis of 8,000, and I have an annuity obligation of 10, and the trustee uses that appreciated asset to satisfy its $10,000 obligation, there's $2,000 of gain recognized, and it doesn't make a difference whether the CLAT is a grantor or non-grantor CLAT. And the IRS in that letter ruling really reiterated that.
Yeah, that's just a bedrock tax principle. Goes way back.
And that 54 revenue ruling was based on the fact that a charitable pledge was not enforceable.
I see.
But it didn't matter because the obligation is established by the trust, not by your charitable pledge.
All right, so very much appreciate all your time and attention, the ability to present for you. Michael, Jerry, thank you very much for all that you've done for us and in the profession.
All right, fantastic. Well, thank you, Alan, Brandon, Michael, and Jerry for a great presentation and sharing your expertise with our members today on a very important topic. We really appreciate it. And as a reminder for our attendees, we're going to process your CPE credit within 24 hours, and you're also going to get an archive recording of this webinar and a copy of the handouts for your own reference. And we're also going to send you a link to an evaluation form, and that's going to be in your inbox. So make sure you take a few minutes to fill that out with your comments and feedback and tell us how your experience was today. Thank you again to Alan, Brandon, Michael, and Jerry, and thank you to all of you for attending today. Make sure you check out our calendar on cpaacademy.org for upcoming webinars, and we hope to see you again soon. Have a great day, everyone.